Hello everyone, welcome to my channel. Today I'm going to discuss a very important and often heated topic, the comparison between the United States and China stock markets. We'll talk about bull and bear cycles, political backgrounds, and how these factors might shape each market's future. We'll also touch on how leadership and political structures can influence not just investor sentiment, but also the overall direction of a nation. But hang tight, because we're going to keep it simple, straightforward, and hopefully very insightful. By the end of this video, you'll have a clearer picture of the unique dynamics of both stock markets and some actionable tips for investing during uncertain times. Before we begin, if you're new here, do me a huge favor. Hit that like button if you find this video helpful. Tap that subscribe button if you enjoy discussions about global markets, investing strategies, and the intriguing relationship between economics and politics. I promise you, this journey is going to be both eye-opening and practical. Let's dive right in. First things first, how do the US and China stock markets really differ? If we look at long-term trends, both markets have grown over time, largely in line with their respective economic expansions. Historically, we know that stock markets generally reflect the health, prospects, and growth rate of their underlying economies, bull and bear cycles. United States. The US stock market is known for its long bull sessions, periods where stock prices go up steadily over multiple years, and comparatively short bear sessions, which can be sharp but often don't last as long. China. In contrast, the Chinese stock market tends to experience longer bear sessions and short, sharp bull runs. That can be exciting when the market takes off, but it can also be frustrating during prolonged down periods. Market sentiment. Part of the reason behind these differences might be cultural, regulatory, and structural factors. US markets are older, more established, and heavily influenced by institutional investors. Meanwhile, a significant portion of China's market is driven by retail investors, who can be more reactive to policy changes and market sentiment. Lower correlation nowadays. Interestingly, the correlation between the US and Chinese markets appears to be lower now than it was 10 years ago, possibly due to evolving political and economic circumstances. Investors might notice that bad news in one country doesn't always translate into equivalent market moves in the other. Now, let's step back and look at the political systems involved, because politics can, and does, impact market performance. Democracy versus communism. In the United States, the political system is generally called a democracy, although in practice it's more specifically a constitutional republic. People have the power to elect their own president, and this can lead to changes in policies that directly affect markets. In China, the ruling party follows a communist framework with socialist characteristics. Decisions are often made more centrally, which can mean swift policy changes that can quickly affect market conditions, sometimes for the better, sometimes for the worse. Pros and cons of each system. It may be tempting to say one system is automatically better than the other, but in reality, every system has pros and cons. Democratic systems offer more individual freedoms and often a robust environment for innovation, but it can also lead to political gridlock. Meanwhile, a centralized system can respond rapidly to economic shifts, yet it may face criticisms about freedom of expression or transparency. Let's bring it home to a very recent and hotly debated political topic in the US. There was a rumor that former President Joe Biden used fraud to get into office. A significant number of people believe this claim, while many others say there's no concrete evidence. For clarity, official investigations and legal courts have not validated widespread election fraud, but perceptions do matter in politics, and perceptions can influence investor sentiment. During the Biden administration, we witnessed several major events: the Russia-Ukraine war, the border crisis, rising inflation, and the controversial Afghanistan troop withdrawal. Some argue that these events brought significant challenges to the country, while others say these were influenced by complex global factors rather than just one leader. Now, fast forward to 2025, and many people say that the US public made a wise decision by re-electing His Excellency President Trump. Supporters believe he will bring peace and prosperity, while critics point to controversies, strong rhetoric, and policy disputes from his previous term. Regardless of personal opinions, one thing is for sure: changing leadership often brings shifting policies, which can lead to new market highs or lows, depending on the circumstances. Disclaimer: remember that allegations of fraud in the 2020 election remain disputed. Multiple reputable sources have found no substantial evidence for widespread irregularities, and the topic is still debated. Ultimately, whether or not you believe those claims might influence how you view political outcomes, but it's always best to do your own research. One fascinating point is the idea that the type of leader who enters office also depends on the collective energy of the people. This viewpoint suggests that a nation's mindset, values, and moral standing collectively shape the leadership that rises to power. In other words, there are no outside enemies. It's about our internal actions and collective consciousness. If Americans focus on unity, economic development, and global leadership with integrity, they might elect leaders who reflect those ideals. Similarly, China's leadership is also shaped by its people, though in a different electoral context. The direction of the country reflects national values and the will of the Communist Party, which in turn is influenced by internal governance and the sentiment of 1.4 billion people. While this might sound a bit philosophical, you could argue that what happens at the political leadership level indeed mirrors the deeper currents of a country's cultural and emotional state. So what does all this mean for your stock investing strategy? Let's boil it down: long-term growth. In the long run, major stock markets, whether in China or the US, tend to go upwards in tandem with economic expansion. That's why many long-term investors preach the buy and hold strategy, believing that, over time, markets will reflect the overall growth of the economy. Bull and bear durations. In the US, the bull markets may run longer, with occasional sharp corrections. In China, you might see extended downtrends, or bears, followed by a shorter, more explosive upward movement, or bulls. Political shifts. Leadership changes or major policy shifts can create volatility. For instance, if the US sees policy changes that favor big business, lower taxes, or certain industries, those sectors could rally. In China, central government directives about tech, real estate, or foreign investment can heavily sway domestic stocks. Geopolitical relations. Tensions or alliances between the US and China also impact global markets. Tariffs, trade deals, and regulatory changes can spur short-term market swings. For instance, a favorable treaty might boost certain export-oriented sectors, while new tech regulations might cause a dip in a specific set of companies. All right, now for the part that might help you in a tangible way. Diversify your portfolio. Don't go all in on just one country. While it's tempting to stick with what you know best, having a balanced mix of US, Chinese, and other international stocks can help you hedge against region-specific risks. Stay informed about policy changes. Whether it's the US or China, policy can shift quickly. Keep an eye on announcements from the Federal Reserve, White House, State Council of China, or the Communist Party's major conferences like the Two Sessions. These can signal upcoming regulations, stimulus measures, or restrictions that will affect entire industries. Look for undervalued opportunities. A prolonged bear cycle in China might present chances to buy good companies at a discount. In the US, a sharp bear session might be your signal to get in on high-quality stocks before the next bull run. Maintain a flexible mindset. We're in a fast-changing global environment. The pandemic, geopolitical tensions, and technological revolutions mean you have to stay agile. Be prepared to tweak your strategy based on evolving events, rather than sticking rigidly to preconceived notions. Exercise caution with rumors. In this digital age, rumors about political fraud, global conspiracies, or guaranteed stock market collapses can spread like wildfire. Always cross-reference your sources, whether it's election-related claims or stock tips from social media. Do your own due diligence and don't rely solely on hearsay. Let's imagine you're an investor in early 2025, right after President Trump retakes office, based on the scenario some are talking about. The market could react with short-term volatility. Some sectors might surge on expectations of lower taxes or deregulation, while others could remain cautious due to potential trade tensions with China. Simultaneously in China, if the government signals supportive measures for tech companies, you might see an explosive short bull run in that sector. Balancing the possibility of ongoing US-China rivalry with signs of economic cooperation can help you position your portfolio to capitalize on the upside while mitigating risk. And that's a wrap, folks. I hope this video has shed some light on how the US and China stock markets differ and why politics can play such a huge role in shaping market cycles. If you found these insights valuable, hit that like button so I know you enjoyed it. Subscribe to the channel for more deep dives into economic trends, global markets, and smart investing strategies. Share your thoughts in the comments below. Which market do you think has the bigger potential in the next 5 years, and why? Thank you so much for watching. Remember, the key is to stay informed, remain flexible, and keep an eye on the bigger picture. Until next time, take care and happy investing.